Hello and welcome to another video on how to secure yourself financially. So after I look at the SED.gov, right, this beginner guide to financial statement, where here it illustrates that if you're able to read nutrition labels or baseball, soccer box score, you can learn to read basic part of financial statement. And if you can learn how to apply for a loan, or if you know how to apply for a loan, or follow a recipe, you can learn the basic part of accounting. And they are basic, they're difficult, they're rocket science. So this section, okay, will teach us how to read basic part of financial statement. So much like a CPA class teach you how to perform the basic part of financial, how to perform the basic cardiopulmonary resuscitation. So in this section, we're gonna see how to read basic part of financial statement, but that won't train me to be an accountant. So much like a CPA course won't train you to be a cardiac doctor, but it can give you some confidence. So when you're able to see a set of financial statement, you can make sense of that. So after all, they show you the money, this financial statement. Okay, so from the Cuba Gooding Jr. immortal line from Jerry Maguire movie, show me the money. That's what financial statement do. And you have four of them. Balance sheet, that show what a company owns and what it owns at a fixed point in time. Income statement, how much money a company made and spend over a period of time, as well as the cash flow, which shows the exchange of money between the company and the outside world, and the statement of the shareholders that show change in interest over time. So it showed the change in interest of the company shareholders over time. So this section only focuses on the first three, the balance sheet, income statement, and cash flow. So the TLDR of the balance sheet is just a snapshot of the company assets, liabilities, and shareholders' equity, where assets are anything that a company owns that has value, okay, whether it's physical or intangible, right? Liabilities are obligations that a company has to pay in the short term, the long term, and equity or shareholders' equity, right? So it is the money that will be left over if the company decide to sell off all of their investment and sell off all of its assets and pay off all of its liabilities, right? So if a company decides to sell all of the assets and pay off all of its liabilities, so the leftover money belongs to the shareholders or the owner of the company, right? So generally this is less using the formula of the assets are equals to the liabilities and the shareholders' equity. And here, generally you will find in a layout in that order, or you might find that with all the assets listed on the top, followed by the liabilities and the shareholders' equity. So the bottom of a financial statement that follow that formula, so generally lists all the assets based on how quickly they can be converted into cash. So you have current assets such as inventory, and which is a short term, right? assets that a company expect to convert that into cash within a year, meaning, for example, is inventory, and non-current assets are assets that a company doesn't expect to sell that, or it will take longer than a year to do that. And also the fixed assets, which are assets that a company needs to run its business, and they are not for sale. So liabilities, we have here short-term liabilities or the current liabilities, okay, where now this is our obligation that a company have to pay off within a year, okay, and they generally listed in liabilities you see is, or this generally is listed based on their due dates, okay, current liabilities and non-current liabilities, okay, or long-term liabilities, which are obligations that a company have that lasts more than a year, as well as the shareholders' equity, right, which is the total amount of money that the owners of the company invest in the company assets, plus or minus earnings or losses since inception. So then I look at the income statement that, sorry, so this income statement, sorry, so the income statement now it shows you the how much money a company made or spent, right? So the bottom line of this statement show you is the profit or losses. So this is generally laid down, or you can think of this as a set of stairs that you start at the top, and each time you go down one step down, you make a deduction associated with that earning, and the bottom line or the bottom of the stair tells you if a company made a profit or not. So generally speaking, you have is your total amount of revenue, and then you make deductions from merchandise returns or discounts until you reach to the net revenue, or the net revenue. And they call that net because if you can think a net, that leftover, so all the leftover items in the net are called because of that. So this is the net revenue. Generally speaking, you also make deductions like cost of sales, which is the total amount of the money that a company spend on produce the good and service over a period of time. So the cost of sales, once you deduct that, you reach to the gross profit, and here is when you deduct things like operation expense. Meaning is expense that a company incur for its day-to-day activities like marketing, administering salaries, research and development, and also things like the amortizations and depreciations, which is something that you take in account. Once you deduct that, you reach to the operating profits before interest and income taxes. So that is, in the case of the interest, is, for example, broadly speaking, is money that a company lend or borrow, all right, in which they can own or earn some interest. So, for example, money market funds is one instrument. And the other is the income tax, so money that a company owns to the government. So once you deduct that, okay, well, now you reach to the net income, and you're now able to see if a company made profit or not. Okay. And lastly, I look at the cash flow statement. Very, very important, because this report, if the cash flow, the inflow of cash, or the inflow and outflow of cash. Okay. Which is this, right? The inflow and outflow of cash. So the company's inflow and outflow of cash. And this is something important, because companies need to have cash to pay this expense or purchase assets. Okay? So, this statement, okay, is it reviews information from the balance sheet and the income statement, and it generally is made of three parts. So the cash flow review, the cash flow statement review the cash flow from one of these activities: operating, investing, and financing. And the bottom line of this statement show you the net increase or decrease in cash, right? So the first part of the cash flow statement, the operating activities, what it does is to look and analyze the net income from the income statement, and then conciliate with the total amount of cash that was used or perceived from operating assets and liabilities. Operating activities. The most common operating activities you have is operating assets and liabilities, where operating assets such as accounts receivable, inventory, prepay expense, which are expenses that a company incur for goods and services that will be received, such as premium insurance, whether it is healthcare, whether it's health for medical coverage, life in the event of the policyholder's death, liabilities like lawsuits, home, your vehicle, to protect those belonging for any potential accident or disability, as well as long-term care, such as nurse home care or home health care. So marketing, rent, software license, maintenance contracts are another example of prepay expense. Keep looking at other operating, most common operating activities. Intangible assets like patents, which are exclusive rights to provide, exclusive right to creator of original or inventors, so they can manufacture, distribute, and sell that invention over a period of time. Most common example of that is, according to Popular Mechanics, is or a couple patent that changed the world, according to Popular Mechanic website, is maglev. This electromagnetic inductive system for stabilization and suspension ground vehicle, issued in 1969. China used that vastly. Okay, it is very, very awesome to know a little bit more about that. GPS, which is something that we can perceive that. Okay, and that is navigation system with passive ranging techniques, as their patent name called, issued in 1974. The electronic device, or aka iPhone, issued in 2004, as well as Chris gene editing, issued in 2014. Trademark, which are unique design, sounds, or image that uniquely identify this competition or this company from the competition. Alright, so for example, Michael Buffer, and it is famous quote from Let's Get Ready to Rumble. Let's get ready to rumble! Things like that. I don't know if I did that great. But yeah. Trademark, which now are exclusive rights to creator of original works, so they can manufacture and distribute their inventions over a period of time, as well as trademark, the trade secrets, which are confidential data that a company used to exchange confidential data that a company used to exchange. This is confidential data. Okay, so that company used to gain some competitive advantage, whether are a process or operations of process, formulas, or customer lists. So goodwill is another intangible assets, which are your brand recognitions, reputations, and customer loyalty. And the other is the now investment in affiliates, such as joint ventures, where now it's a partnership between two or more companies to undertake a specific business activity or a project where each part receives a share of that. So, for example, Crocs and Post Malone. Okay. The other is limited partnership, where now an investor purchase significant amount of stocks on the limited partnerships in return of the partnership assets and operations. Equity investment, which are very, very common here. Holding companies or companies and investors that purchase significant amount of stakes in the another company and potentially write its voice and influence its company management decisions, such as equity Berkshire Hathaway, led by Warren Buffett, where now this is a holding company that invests in a variety of sectors such as industry, energy, retails, Texas Pacific Groups, which is a private equity that invests in primarily healthcare and real estate. Google or Alphabet, which is the Google parent company that invests in primarily technology company through its venture capital arm. Calico is one example of that. It's a longevity company. Also, things like SoftBank, which is a Japanese conglomerate that invests primarily in technology companies such as WeWork, Uber. So you get the idea. And ultimately is associate, which are companies or investors that have 20 to 50% of the another company stocks. And cash and cash equivalent, which is another operating, a common operating assets, is, well, these money market funds that primarily invest in a very short term debt financial instruments. The idea here is to get liquidity fast. So they invest in, for example, bank acceptance, which is debt issued by banks, very short term debt issued by banks, certificate of deposit, savings certificate issued by banks with short term maturity, commercial paper, unrisked or very risky commercial debt or corporate debt, and repo. This repurchase agreement where this repurchase agreement where this is very short-term debt issue by the government. So then I look at the most common operating liabilities like accounts payable, money that you own to, or the money that a company owns to the employers, to their vendors and suppliers, usually something around 30 to 60 days. For things like raw materials, office supplies, service, accrue expense, which are money or is good and service that the company has collected but not yet paid for, meaning wage and salaries, rent, taxes, utility bills, deferred revenues, which is the obligation that a company has to provide good and service in the future based on money that has been collected, such as subscription service or gift cards, income taxes payable, so money that a company owns to the government, such as corporate taxes. In the US is something around 21%, so it's going to depend on the country. You have that. The other is sales or state, withholding taxes, which is money that the employee deducts from the gross employee's salary and pays directly to the government. And this is to promote the pay-as-you-earn tax system to fight tax evasion. And the other, the other is sales taxes, which is state sales taxes or city, county sales taxes, VAT, value added tax, which is a tax imposed on the production of goods and service at each stage since the manufacturing and until the distribution, where the customer ultimately pay the full VAT, but business along the supply chain remit that portion to the tax. Excise tax, where these are a tax imposed on certain goods like tobacco, alcohol, gasoline, guns, and GST, the good and service tax, which is imposed over the VAT in places like Canada, Australia, and India. Okay. And then I also look at Short-term borrowings. So, for example, companies that wants to meet their financial needs or working capital needs. Okay, so working capital is a measure of the financial and the short-term financial health of a company. And this is the difference between the current assets and the current liabilities to see if a company have enough liquidity to pay its obligations in the short term. So you have is a banks, a business, the banks, line of credits, they issue debt. For example, company can issue debt or these commercial papers, so they can raise funds for that. Trade trade borrows or trade loans, especially when you want to negotiate to your suppliers and vendors on and reschedule the repayment date. Outstanding invoice. So when you show your invoice to a lender where it analyzed that, and based on this document, well, it's going to lend you some money. In the payroll advance, okay, which are so the employee, the company give an advance to employees that will be deducted in the next payday. So with that, then I look at the notes payable. And in contrast with this short-term borrowing, notes payable is an agreement between the borrower and the lender that the borrower outline all the terms and conditions of that loan. Okay, so for example, you have banks. When anytime you ask a loan for a bank, it generates this. So where it outlines the principal, the interest, the repayment schedule, among other details. You have banks. The other is companies between the business. So instead of going to a bank, company can go to a financial institution such as private equity or venture capitalists. Okay, so when they create these terms of conditions, outline all the necessary data of that loan. Trade credits, which is trades payable, where now this, in some case, so company can renegotiate the repayment schedule with their suppliers and vendors. The other is notes payable. This is now issued directly to individuals or business when the borrower asks a loan for a lender that outline all the necessary conditions for that. Also, bonds is another notes payable that indicate is the principal as well as the timely interest rate that you will get from. And ultimately, the warranty obligations, which are now obligations that a company have to fix or replace a defective product or a product that doesn't meet certain quality standards. All right. Here you have warranty obligations. Here you have is warranty obligations. How do you put it? Exactly. So warranty manufacturing warranties, service, and parts, vehicle, auto, which is the same, home. So with that, all right, uh, this is the most common operating activities in a business. Okay, so this, the first part of the cash flow statement, what it does is to analyze that. Okay, and the way to do that is first it look at the net income and adjust for any non-cash items, so items that affect the income statement, such as stock-based compensation, amortization, that kind of thing. And it also adjusts the total amount of cash that was used or perceived from other operating activities. Okay. So the second part is the investing activity, which is generally involve the purchase or sale of long-term assets. Long-term assets we have is intangible assets, property, plant, and equipment, uh, goodwill, leasehold installments when you want to make some extensions on a property. Investment, okay, is another long-term asset here. Investment. So with this, so for example, okay, so with the investing activities, like if a company decide to purchase a property, okay, this activity is registered as a cash outflow because cash was used to pay for that. However, if a company decides to sell some investment or decide to sell a, a machinery, okay, so this activity is registered as a cash inflow because cash was used, cash was perceived from the operation. And the other source, the third part of the financial statement is the financing activities. And when we talk about financing, is it involves the company's long-term obligations and equity, meaning it involves the long-term obligations and ownership. Okay. So when I look here at this, okay, long-term assets, right? Long-term assets, looking is more like the financing activities, right? So, yeah, this financing activity mentioned that, okay. And when I look at the Investopedia, financial. So, what are the financial security? No bonds. Bonds, financial meaning. No what? Financial activities. Okay. So cash flow from financing activities. That's right. CFF. So cash flow from financing activities. Okay. But this is the formula. No, but formula and calculations. But I just want to look at financial statement list of type of how to read them. Accounts receivable, liabilities. This is describing is the most common liabilities and assets. Prepay expense, property, plant, and equipment, investment, trademarks, so liabilities, shareholders' equity, and things like that. So okay, this is the income statement, okay, and expense and the cash flow, right? So the operating activities, investing activities, and financing activities. So financing activities, right? It is funny because cash flow from operating, cash flow from investing. So now looking at this, okay, so investing activities, financing activities, cash flow from financing activities. Example of cash flow statement from the ExxonMobil. From the ExxonMobil. Okay, but this is what are financial statements. Okay, so cool. That's right. Okay, investor warnings from CFF, real world example. Okay, but just want to look at the financing cash flow statement, analyzing financial activities like this. Okay, so financial activity involving the company, long-term liabilities and equity. So meaning the financial activity according to Investopedia. So the financial activity in the cash flow statement focus on how a firm raise capital and pay this back to investors through capital markets. So the end goal of this is to sell that business or to make this IPO, initial public offering, and with that repay them to the investors. Okay, all right. So activities involved here, okay, activities involving financing activities are raising capital from investors or creditors, repay debt, or distribute profits to shareholders. Okay, so here we have issue equity, issuing debt, repaying debt, obtaining loans, payments of dividends, repurchasing stocks, which is it's a self-financing, okay, leasing into a lease agreement to acquire assets such as equipment, building, or vehicles. It's an agreement. Leasing allows a company to use the asset without taking ownership and can be considered a form of financing activity. So convertible debt. Some debt instruments such as convertible bonds or convertible preferred stock allow the holders to convert their debt into equity share of the company. This provides the options for debt holders to become shareholders in the future. But with that, so that'll be all for this video. Take care. Bye bye.